Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of June 16th. Thank you for joining us. If you're a first timer, we're glad you found the podcast. And if you're a returner, we're glad you come back week after week. So with that in mind, the purpose of this podcast is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start by taking a look back at last week. So as far as the tariff situation, we saw trade negotiations with China early in the week, ultimately resulting in an outline for a tentative trade agreement, at least in part on some major topics with China. We also saw the Trump administration announce that within the next few weeks, they will most likely be sending out letters with unilateral trade offers to their existing trade partners. And this is important because every week we creep closer and closer to the July 9th deadline when the Liberation Day tariff pause should expire. Analysts and experts these days are suggesting that we may see the pause extended for some countries, the pause ended for other countries, and potentially these unilateral offers accepted by some trade partners and implemented around that same time frame. In addition to tariffs, we also saw our weekly unemployment insurance report last week. Unfortunately, the unemployment insurance picture shows a continuing deterioration in the labor market. We saw initial claims essentially plateau out at the same level as last week, which remains at a recent high. We also saw the continuing claims increase by a significant amount, ultimately reaching their highest point since November of 2021. Last week was a big inflation week. We saw the Consumer Price Index and the Producer Price Index reports for the month of May. And fortunately, both of these reports came in softer than experts and analysts had expected. The Producer Price Index actually saw a reversal of fortune in the month-to-month rate, whereas in April we saw the month-to-month rate decline. In May, we saw that month-to-month rate increase. And despite this slight turn of events, we did see the 12-month rates increase slightly at the headline from 2.5 to 2.6, but decrease at the core from 2.9 to 2.7. So as has been the case for the last few months, ultimately a mixed results report, but in all cases, better than what was expected. The Consumer Price Index also was a mixed report, but better than expected. We saw the headline number for 12-month price changes increase from 2.3 to 2.4, but fortunately we saw the core, which excludes food and energy, remain the same in May as it was in April, of a 2.8% 12-month increase in prices. Turning our attention to some of the other economic data from last week, we saw wholesale inventories increase slightly. We saw the quarterly report for the first quarter showed retailer and manufacturing profits fell in the first quarter. And we saw that new business applications in the month of May declined slightly. We also saw the monthly Treasury Statement coming out of the federal government, ultimately showing the amount of money they've received and spent so far in the fiscal year. We saw that the Treasury deficit, or the federal government deficit, for the current year increased to $1.37 billion, which is more than the last 2 years. But in contrast to that, We also saw that the customs tax duties, otherwise the tariff taxes, increased by $22 billion in the month of May. Ultimately, we saw the monthly deficit compared to 1 year ago in the same month decreased by about 9%, in large part as a result of the additional tariff taxes. Last of all, before we switch over to earnings in the stock market, we saw the preliminary consumer sentiment results for the month of June released, and we saw the consumer sentiment index improve for the first time in 6 months. Ultimately, we saw less panic, and we saw a relaxation of pessimism and concern across all broad areas of the survey, but there was also clear indications that consumers remain hesitant and slightly anxious as they observed several potential economic downsides in the near future, including taxes, tariffs, and potential economic slowdowns and unemployment. Taking a quick look at corporate earnings, as we wrap up the first quarter of 2025, corporate earnings were significantly better than initially expected. The initial estimate was that earnings would grow about 7%, and the actual earnings growth in the first quarter was about 13%. In addition, we saw about 78% of S&P 500 companies reporting a positive earnings surprise, meaning they did better than expected, and about 64% of S&P 500 companies reported a positive revenue surprise. Now, looking ahead to the second quarter of 2025, there's again an air of skepticism and pessimism floating around. The initial estimates for earnings in the second quarter were about 9% earnings growth, and those estimates have now been revised down to about 5% earnings growth. Here in the next few weeks, as we transition out of the second quarter and into the third quarter, we'll start to see earnings reports, and we'll see if those fears materialized. It was a rough week in the stock market last week. Despite the markets being up throughout the majority of the week, they took a sharp downturn on Friday following Israel's attacks on Iran. Ultimately, the S&P 500 ended up the week down slightly. The Dow Jones Industrial Average was down more than 1%, and the NASDAQ was down about 0.6% by the end of the week. Israel's attacks ultimately provoked a short-term shift in risk preferences, as we saw assets that are typically considered higher risk, such as stocks and Bitcoin, take a sharp dive, and assets that are typically viewed as safe havens, like gold, show a significant increase. The yield on the 10-year Treasury was ultimately falling throughout the majority of the week as we saw a successful auction of longer-dated Treasuries, 10 and 30-year Treasuries, and we saw softer than expected inflation. The yield on the 10-year Treasury had dropped to about 4.3% before Israel's attacks on Iran later in the week, ultimately causing a sell-off in long-term government treasuries and pushing yields back up to about 4.4%. Bitcoin also had a pretty great week until the end, ultimately crossing the $110,000 mark and reporting a 30 consecutive day period of greater than $100,000 price tag for the first time ever in history. Unfortunately, following Israel's attacks, as the risk preference shifted to safety and caution, Bitcoin dropped from above 110,000 to approximately 103,000. Crude oil prices had also been climbing throughout the week, but following Israel's violent attacks on Iran, we saw the price of crude oil spike by more than 10%, ultimately reaching a high that we hadn't seen previously in 2025. As conflict in the Middle East continues to unfold, the concern, of course, has to do with the ability to provide and extract oil, as well as transport that oil around the Middle East corridor and through the Red Sea. As the conflict unfolds, we'll continue to watch the price of crude oil and the impact that may have on inflation in the U.S. and the global economy. The U.S. dollar also had a pretty rough week, but it had been losing value prior to Israel's attacks. And the attacks on Thursday night only served to further exacerbate that loss in value of the US dollar. Now, the interesting fact, as far as the US dollar and government treasuries are concerned, is that historically, when conflict has arisen and there was global turmoil, either geopolitically or economically, the United States, specifically treasuries and the US dollar, were viewed as safe haven assets similar to gold. In this most recent bout of turmoil and shift from risk to safety, we actually saw the opposite. We saw the US dollar continue to sell off. We saw US long-term treasuries sell off. And what this implies to analysts and economists is that it's possible that the US economy and US assets are no longer being viewed as the safe haven that they once were. This, of course, creates some concern and will cause us to pay much closer attention on these assets moving forwards. Looking ahead to what we can expect this week, the headliner is the Federal Reserve announcing their most recent interest rate decision. The Federal Open Market Committee will meet on Tuesday and Wednesday. Wednesday afternoon, Fed Chairperson Jerome Powell will actually give his summary and his press conference with the press around 2:30 Eastern. And with that, analysts and experts are not expecting to see a rate cut this meeting. There's also quite a bit of skepticism as to whether there will be any potential for a rate cut at the July meeting. But what will be of interest and of value, even if rates are unchanged, is, of course, how the Fed chairperson answers questions at the press conference, and the Federal Open Market Committee will be releasing their regular summary of economic projections, meaning that we'll get some insight as to how they see the economy unfolding in the second half of 2025. Also this week, we'll get our weekly unemployment insurance report on Thursday. The key to this report is whether we continue to see a deterioration in the labor market or whether we see a reversal of fortunes and a normalization of the currently high levels of insured unemployment. In addition to the Fed's decision on interest rates, this week we'll actually receive a wide variety of economic data, including import-export price updates for the month of May. We'll see retail sales numbers, we'll see business inventories, we'll see industrial production and capacity utilization. We'll also see the beginning of some monthly housing data coming out this week, and we'll see manufacturing surveys from New York and Philadelphia, kicking off the monthly manufacturing reporting of the Federal Reserve's regional banks. Looking ahead to the future, unfortunately, uncertainty doesn't seem to be going anywhere, as there are still big questions as to long-term tariff rates, the debate ongoing around the Big Beautiful Bill, growing geopolitical tensions, potential economic slowdown, potential deterioration in the labor market, and both consumers and businesses, although less panicked, remain continuously cautious and slightly pessimistic relative to previous years as to how the second half of the year will unfold. With that in mind, one of the things we do best, for those of you that come back every week, you already know this, but one of the things that we do best is reading through all the economic reports, looking through all the economic data, analyzing and interpreting what the analysts and economists are telling us, and bringing you the big important stories here in an easy to understand manner. So with that said, I want to take a minute to thank you for joining us this week. I want to encourage you to come back every week and check out these videos and these updates. I'd also like to encourage you to like and subscribe to the video and the channel if you find these videos helpful. And if you have a minute, check out some of the other videos here on the channel. With that said, if you've got big questions, feel free to throw those in the comments and we'll do our best to include them in the next video. But with that, have a great week and we'll see you in next week's video.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.